The bill is heavily skewed toward making it easier, cheaper for businesses to invest, grow, and operate, specifically in the U.S., starting with pass-through businesses,
Hmm.
S-corp partnerships, sole proprietorships, where profits pass through to the owner's individual return.
Right. Millions of small and medium businesses.
Exactly. The Section 199A deduction for their qualified business income, QBI, it's increased from 20% to 23%, and it's made permanent beyond 2025. That lowers the effective top tax rate on that income.
From about 29.6% down to around 28.3%, roughly.
Yeah, that's about right, a noticeable cut. And for investment itself, it restores and extends full 100% bonus depreciation for several years. This is huge.
Allowing immediate write-offs.
Immediate write-off of the entire cost of new equipment, machinery, placed in service from late 2025 through 2029, instead of depreciating it slowly over years. That's a massive incentive to buy now. And the Section 179 expensing limit, which mainly helps smaller businesses deduct property costs up front, that's more than doubled, from $1 million to $2.5 million. And the phase-out threshold goes up too. And crucially, R&D costs, research and development. Businesses recently had to start amortizing those, spreading the cost over several years.
Right, that was a big change that caused some heartburn.
A lot of heartburn.
Yeah.
This bill temporarily reverses that through 2029. R&D costs can be fully deducted in the year they're incurred again. Huge incentive for innovation.
So if I'm a business looking to expand, buy equipment, invest in new tech, this bill is basically flashing a giant green light and offering a significant tax break.
Absolutely. It's a massive incentive. And it goes even further with specific manufacturing incentives. There's a special qualified production property, full expensing deduction.
What does that mean?
It means a 100% immediate write-off for new U.S. manufacturing facilities placed in service before 2033. A direct push to build factories here. It also launches a second round of Opportunity Zone designations for 2027 to 2033. But this time, they're specifically focusing on underserved rural areas, and investments in those rural OZs get an even bigger basis boost, 30%.
Interesting focus on rural development there. What about financing costs, like interest expense?
Right. For financing, from 2025 through 2029, the bill loosens the business interest expense limitation. That rule restricts how much interest expense a business can deduct each year. The bill reverts to the more lenient, older EBITDA-based limit for those years. EBITDA is earnings before interest, taxes, depreciation, and amortization. Adding back D&A makes the limit higher.
Benefiting companies with lots of assets or debt.
Exactly. Capital-intensive firms, companies that carry a lot of debt, they benefit significantly from that change. And what's also notable, often a point of contention, is that the bill does not alter the tax treatment of carried interest.
The private equity hedge fund manager income.
That's the one. Leaving the existing rules in place, which tax it often like capital gains, signals a very deliberate choice to maintain that favorable structure for those high-income individuals.
Now let's zoom out a bit to the corporate level. Big C Corp. How does this big, beautiful bill reshape the tax environment for America's largest businesses and maybe certain industries?
Okay, for C corporations, there's a new interesting limit on philanthropy. They can only deduct charitable contributions above 1% of their taxable income. It's like a floor before the deduction even kicks in.
That's unusual. A floor, not a ceiling.
Right. It also tightens executive compensation limits. Remember the $1 million deduction cap on top executive pay?
Section 162 hours.
Yeah. It expands that cap to apply across an entire corporate group, not just the top people at the parent company. Makes it harder to deduct massive executive salaries across subsidiaries. On the energy side, the definition of qualifying income for Energy Master Limited Partnerships, MLPs, those publicly traded partnerships with tax advantages, it's expanded. Now it includes carbon capture, electricity generation, and some fuel transport and storage.
Opening up MLPs to new energy types.
Yes. And maybe a niche item, but it limits the amortization of newly acquired professional sports franchises to 50% of the asset's basis. Curbs a tax break that some saw as overly generous for team owners.
Okay. What about smaller businesses and reporting? Any changes there?
Yeah, a couple of things. It eases compliance a bit by raising the Form 1099-K reporting threshold. That's for payments from platforms like Etsy, eBay, PayPal. The threshold goes up from $600 to $2,000.
That'll make life easier for casual sellers.
Probably. But on the other hand, it significantly cracks down on fraudulent employee retention credit, or ERC, claims from the pandemic era.
The ERC mills.
Exactly. It disallows any new claims filed after January 31st, 2024, and imposes stiff penalties on those ERC promoters, the firms charging high fees for, let's say, dubious claims. A clear message there. But perhaps one of the most significant shifts on the business side is in energy and climate tax credits.
Ah, rolling back the Inflation Reduction Act incentives.
Largely, yes. The bill rolls back many of those clean energy incentives. For instance, wind and solar investment and production credits. They get phased out for projects starting construction after mid-2026 or in service after 2027. Popular electric vehicle tax credits terminated by September 2025. EV charging station credits end by mid-2026.
Wow, that's a sharp reversal.
It is. Conversely, the bill extends biofuel tax credits for 4 more years through 2031, and it introduces a brand new 2.5% tax credit specifically for metallurgical coal production.
So definitely shifting focus away from renewables towards traditional energy and extraction.
That's the clear signal, yes.
That's a profound reorientation of energy policy. What about other sectors, like higher education, nonprofits? And how does this bill touch upon international tax rules?
Right, it hits those too. The bill actually increases taxes on wealthy private universities and foundations.
Increases? How?
For large university endowments, that existing 1.4% excise tax, it's replaced with a tiered excise tax, goes up to 8% for the very largest endowments, those well above $500 per student. And for private foundations, the flat 1.39% excise tax is replaced by a graduated rate. For example, 5% for foundations with $250 million to $5 billion in assets, and 10% for those larger than that.
So the wealthiest universities and foundations will see a notable tax hike.
Definitely. On the international tax front, the bill largely maintains the favorable status quo for U.S. multinationals. It keeps the global minimum tax provisions from the TCJA, JLTI, and FDII at their current effective rates, around 10.5% and 13.1%.
Those complex rules trying to tax foreign profits of U.S. companies.
Exactly. By keeping those rates stable, the bill signals, let's say, a preference for U.S. competitiveness over aligning with aggressive global tax harmonization efforts, like the OECD minimum tax push, the base erosion anti-abuse tax, or BEAT, which targets U.S. companies shifting profits abroad, also kept at its current 10% rate, and tax credits continued to be allowed against it.
So mostly status quo for multinationals' foreign income.
Mostly. But there's one very assertive new international tax change. It's Section 899, called Enforcement of Remedies Against Unfair Foreign Taxes.
Sounds aggressive.
It is. It's basically a retaliatory measure. It authorizes penalty tariffs, higher U.S. tax rates up to an extra 20% on companies or residents of foreign countries that impose taxes the U.S. deems discriminatory to American firms.
Like digital services taxes?
Yeah.
Or the OECD minimum tax itself?
Exactly. Those kinds of things. If a country gets labeled discriminatory, affected companies or individuals could face an extra 5% U.S. tax per year, potentially rising up to 20%.
Wow, that's a big stick.
It's a very big stick designed to pressure other countries. Though it has a delayed effective date and gives the Treasury Secretary a lot of authority to decide who gets hit.
Okay. Beyond rates and deductions, this bill also reshapes how the IRS operates and interacts with taxpayers. What are the administrative shifts we should be aware of?
Yeah, this is a major area of policy change, directly impacting tax compliance and enforcement. The bill rescinds, or maybe reprograms, a significant chunk of that IRS funding boost from the 2022 Inflation Reduction Act.
The $80 billion infusion.
That's the one. Cutting that back effectively constrains the IRS's planned expansion of audits and its overall workforce. It definitely limits its capacity for enforcement going forward. Then there's the termination of the IRS's new direct file tax return system.
The free online filing pilot program.
Gone. Completely shut down. In its place, the bill mandates that the IRS form a public-private partnership with the existing tax prep companies, TurboTax, H&R Block, etc., to offer free filing options.
So codifying reliance on private software, not a government system.
That's the effect, yes. For anti-fraud measures, the IRS is directed to build a system to detect duplicate claims of the Earned Income Tax Credit, the EITC, where maybe two different people claim the same qualifying child.
Which can happen.
It can. They'll hold refunds until those issues are resolved. Notices start in 2024, delayed refunds expected by 2025 for those flagged claims. It also extends the statute of limitations for the IRS to go after certain cases of underreported income and increases penalties for tax fraud, like fuel tax schemes and those syndicated conservation easements. And related to that, for the COVID-era programs, remember we talked about the ERC crackdown, invalidating new claims after Jan 31, 2024, hitting promoters hard. That's all part of this push to claw back funds and deter fraud.
So the IRS is essentially being told to do more fraud fighting, but with potentially less funding overall, and that a government-run filing option isn't the way forward. Any other notable administrative bits?
Yes, a few others. For example, it gives automatic deadline extensions to taxpayers wrongfully detained abroad hostages, basically.